We will continue our discussion of housing with the home buying process. Yeah, it's not for the faint of heart. There's an entire industry out there, and they just love to shepherd you through the process. And a lot of people just don't know. They just don't understand what's happening to them. So we'll do our best to help you, but it's a daunting task. So let's get started on slide 19. Determine your home ownership needs. Determine how much you can afford. Well, the best way to do this is to get pre-qualified. Go see a mortgage broker that you have a recommendation for, or check out your bank or credit union or another mortgage company, and they will pre-qualify you. This is their job. They will, as we said, basically do your cash flow statement and your net worth statement and look at your income and say, well, this is how much we believe we can lend you. So now you have an idea of how much you can buy. They'll want to know where the down payment is. They're going to want to see the accounts. Where's the down payment? What's your ability to make the payments? What's coming in? What's going out? What's your cash flow statement? The first house you buy, yes, you might decide that it's not exactly what you want, and as you move to a second or third home, you can include more of the features you want. And certainly you're going to want to look at the condition of the home, right? Slide number 20. Finding and evaluating a property to purchase. Select the location. Be very aware of the zoning laws, the conditions, codes, and restrictions. Some places, Rancho Bernardo, you can't even park your own RV in your driveway. I don't know about that, folks. School systems are very important for people who have children. Poway, in our area, is considered a very good school district, and as such, the houses are priced accordingly. There was one school district in Connecticut, I think it was, that had just unbelievable test scores, and the houses were bid up to outrageous prices. And then it was found that the teachers and the principals were all exactly, they were cheating on the exams, making the students look like they were doing better than they did. Oh boy. Should you use a real estate agent? Well, they present your offer, negotiate the price, assist you in obtaining financing, represent you at the closing, and stab you in the back if you're not careful. Okay, I told you by the end of the semester I was going to insult everybody. This isn't to say that there's one or two good real estate agents out there, folks. There are. You got to just get a good referral. And if any real estate agents want to do battle with me, I'd be happy to pull out the research from a badly named book, but a brilliantly written book. It's called Freakonomics, if you can believe that. But this guy is an economist who basically uses great research. I mean, he just digs into these areas where the conventional wisdom is often wrong, and he just uncovered some great relationships. For example, the one having to do with real estate is that real estate agents will sell your house for a certain amount of money, and they get a commission off of that. We'll discuss the commission later on. But when they're selling their own house, they will sell it for the price that they would have gotten for your house, plus then some. They'll sell it for more than what they sell your house for. Well, why? Well, there are certain numbers that we could run through, but essentially, they don't get paid until the house sells, when they represent you or represent a client. So they're doing their best to get a sale. But when they're selling their own house, exactly, they're not getting a commission. what they're doing is they're getting the money from the sale of the house. So they're willing to wait a little longer. And when this research came out, the real estate agents were just, livid. But he had the data to back him up. In general, the real estate agents, when they sell their own house, the house will be on the market longer, and they'll get more money. They'll sell for a higher price. So, are you going to get a good referral? Good. I got the name of a couple of people who in the South Bay who are very honest. One's a pit bull, and she's great. And the other one is he's great. He's really relaxed and very friendly. And I said to him once, I said, how do you deal with all this dishonesty in this industry? And he said, well, some people in the industry are very, very honest, and some people are not so honest. I mean, he just takes it very in stride. You could obtain an appraisal beforehand, but it's going to happen anyway. The bank, the lending institution, is not going to allow the loan to happen without an appraisal to make sure that the house is worth what you're paying. And should you conduct a home inspection? Well, the book and many others recommend this, but my experience and people who I trust have told me that many of these home inspectors really are not that good. They're just not worth the money you spend for them. I would rather contact a contractor or somebody who actually does work and has to redo floors and roofs and basements and whatever, and ask them to inspect my home. Because I'll tell you, my wife and I, completely blindsided by a home inspection that this one gentleman did. Totally ridiculous. Just totally ridiculous. And charged us a ton of money to do it. I couldn't believe it. So you decide. Slide number 21. Check the neighborhood and recent transactions to determine whether or not you're actually paying a good deal. Your real estate agent should help you with that, but we're going to show you an example of Zillow, and there's another one called Trulia that are not the best tools. They're not they're not fantastic, but they're pretty good, and they allow you to check out what's going on. The data's often a little old. The real estate agents hate these people and do their best to make sure that they don't get the right data. But it helps. And also you can just ride around. I like to ride around on my bicycle and just see what things are selling for. Remember that you can go with the agent who is selling the house, or you can get your own agent, a buyer's agent. But just remember that the agents work for the seller. The seller normally will be the one who's paying the commission. So always keep this in mind. You will hear an agent tell you, ooh, you should always use an agent when you're buying because the seller pays the commission. But that same agent will turn around to a potential seller and say, ooh, you should always use an agent when you're selling because the price of the commission is built into the price of the house. Now, I heard this from the same agent on 2 different occasions. And I just grinned and I was about ready to say, but didn't you say? I didn't do it. I just didn't do it because she was a friend of my wife and I didn't want to. Anyway, is it a seller or a buyer's market? Well, it depends who you talk to right now. For a few years, it was certainly a buyer's market. If you could qualify for the loan, if you could come up with a down payment because prices had fallen so far. But now, supposedly, prices are getting tighter, but again, as we said in the previous presentation, I'm not buying it. I don't know if this is it, if this is the beginning of another real estate bonanza. I ain't buying it. What is earnest money? Well, we used to call this a down payment, but it's not the down payment. It's something completely different. It's $2,000, $3,000 to $5,000 that you put down towards the purchase of the home, just to tell the seller that, yes, this is the house I want to buy. Don't try to sell it to somebody else. And what you have to be careful is this money could disappear if, for example, you are not able to obtain financing, or if the sale if you can't buy this house unless you can sell your own house. So what you should write into the selling agreement, the sales agreement, and again, a good agent will help you do this, are what are called contingency clauses. Isn't that a great name? Contingency. I love it the way it sounds when you say it. You can feel your throat vibrate. Contingency. And you can say, you know what? I'm going to put $5,000 down. I want to buy this house, but if I can't obtain financing, you did get pre-qualified, didn't you? Or if I can't sell my own house, I want that $5,000 back. Because if you don't do that and you walk away from the transaction, they get to keep the earnest money. You understand? Yes. Be careful. Be careful. Make sure you've put in those contingencies, because you don't want to be out $4,000 or $5,000. Slide 22. Determine the amount of the down payment. If you have less than 20% down payment these days, they'll often ask you to pay what's called mortgage insurance. And we have a slide just devoted to this scam. I mean, this aspect of buying a home. Yeah, apply and qualify for the mortgage, but you've already been pre-qualified, right? How many times have I said that? I don't know. Remember to be pre-qualified. And then you want to evaluate the points and the interest rates. And there's a document and a commentary on the website about the buy down. The fewer amount of points you pay, the higher the interest rate. The more points you pay, the lower the interest rate. And 1 point is basically 1% of the loan. So as we said, if it's a $300,000 loan, 1 point would be $3,000. And that's just for the privilege of getting the loan, folks. It's a commission, so to speak. And you have to do your own trade-off, your own decision about whether you want to pay fewer points and a higher interest rate or more points and a lower interest rate. But when you take a look at the document, you'll see the trade-off. You'll see that in the long term, it's probably a good idea to buy down the interest rate and pay them more points. But you never know what's going to happen in the future. So many people say, pay the fewest number of points, get a higher interest rate. If interest rates go down, you do it again, right? And of course, it's an eternal struggle. Also, on the assignment sheet, the last question asks you to evaluate, what's going to happen if you do finance your home, and then you have all these closing costs, and how long will it take you to pay it off? The same kind of ideas. These are questions that everybody has to look at and decide on their own. Slide 23. Here we go. PMI, private mortgage insurance. Private mortgage insurance protects the lender from financial loss due to default on the loan. Wait a minute. Notice that it protects the lender. But who pays for it? Right, the borrower pays for it. What a scam. I mean, what a deal. This is usually required if the homeowner puts down less than 20% on the home. Now, I want you to remember this number. When the equity builds to 20%, so it's the same number, right? Either you put down 20% or the house has appreciated and you've been paying down the loan. So you own 20% of the house, right? It's a $300,000 house. That would be $60,000. $60,000 of it is yours. $240,000 of it is the bank's. Isn't that nice of them? They own most of the house, but they let you live there. Once you hit 20%, the PMI, the private mortgage insurance, is supposed to end automatically. But do you think the lender's going to get rid of it? Oh yeah, your house hit 20%. We'll take the PMI. No, they don't want to get rid of it. It's protecting them, and you're paying for it. So you've got to petition them to hey, look, house prices have gone up. My loan has gone down. I have 20% equity. Get rid of this thing. because they're not going to want to do it. Some borrowers avoid it by taking out two loans. They'll take an 80% first trust deed, the fixed, which we're going to discuss on the next slide. And then they'll take 10% HELOC and 10% down, so 15% HELOC, 5% down. So they try to avoid private mortgage insurance as much as possible. As well, you should, because you're paying insurance for somebody else's protection. I don't like it. Slide number 24. All right, let's get down to tax here. Types of mortgages. For decades, the most prevalent type of mortgage, let's get the little magic cursor in here, was the conventional, also called fixed payment, first trust deed. But an adjustable could be a first trust deed, but a fully amortized, which is a fancy word of saying it's stretched out, fixed rate. You know what your payment was for 30 years. You can get them for 20, you can get them for 40 or 15. But 30 years became the norm. And they typically wanted you to put down 20%. But as housing prices started getting higher and higher, maybe 10% or even 5%, as housing prices started to really accelerate in the late 70s, 1980s, 1990s, the adjustable rate mortgage became very popular. What's going on here? With a fixed rate mortgage, you know what your interest rate will be. If interest rates go down, oh well, you can always refinance. But if interest rates go up, you're protected. Well, the industry wanted to share in that risk of interest rates going up and created the adjustable rate mortgage. It usually has a cap, a maximum. Say you start out at 6%, it can only go up to 11%, a 5% cap. And it can only go up every 6 months or once a year, and only by a certain percentage, maybe 1% at a time. So there are some protections built in. But throughout the 1980s and 1990s, interest rates trended down. So people who bought these adjustable rate mortgages looked like geniuses. Plus, they started to come up with more creative ways of selling these things with interest-only provisions, or what is called negative amortization. Negative amortization. That's a fancy phrase for saying your loan's not going down, your loan is going up. What? What kind of loan goes up? Well, it's called the option ARM, the optional adjustable rate mortgage, and it became the darling of the industry during the run-up of 2002 to 2007. You see your neighbors and your friends making money hand over fist. Their houses appreciating 30%, 20% a year. Oh man, I gotta get me into one of these houses, but they're $500,000. They were only $200,000 a few years ago. How do I do it? Well, a friendly real estate agent with the cheap cigars and the leisure polyester suit tells you, we can get you into an option ARM for $500,000. You can buy that house, and you only have to pay $1,600 a month. And you look at him and say, are you serious? Yeah, well, sure, we're serious. How much money do you make a year? $30,000. No, you don't make $30,000. Here, just write down here that you make $120,000. What? Yeah, they were called liar loans. No documentation. They didn't require you to show what your income was. What's the catch? Well, the catch is the loan should really be about $3,200 a month. What's going on with the extra $1,600? No problem. The loan is going up. That $1,600 that you would have paid, that extra $1,600, was being tacked on, was being put onto the loan. And so next year you might owe, $520,000. And you say to the mortgage broker, you say, well, that doesn't sound smart. And they say, what are you worried about? Housing prices are going up 20%. In 2 years, your house is going to be worth $700,000. What are you worried about? Oh, I guess that sounds okay. But also, it says here that next year I'm going to be paying $2,000 a month. Right. It's $1,600 for the first year. Next year, it's $2,000. And then the third year, it's $2,400, $2,500. And then in the fourth year, the loan resets, whatever that means, and becomes fully amortized, whatever that means. And now your mortgage is $3,300 or $3,400 a month in perpetuity for the rest of the loan. And you say, well, Mr. Loan Broker, I can afford $1,600, maybe $2,000, but I can't afford $3,400 a month. No problem. See, it's always no problem. We'll do it again. We'll write another option arm, lower your payments back down to $1,700. Besides, by that time your house will be worth $800,000. You could sell it. Folks, you might think I'm being ridiculous, but I'm not. This is what was going on, folks. And why were brokers selling these things? Well, it allowed people who weren't making a whole lot of money to buy houses that they had no business to buy. But as long as housing prices were going up, everybody was happy. Plus, the brokers made 2 to 4 times the commission on these option arms than they did on the conventional loans. So if you don't have any scruples and you want to make a lot of money, this was a great place to do it. Why did they create these option arms? Well, they were created in the 1980s for people whose income was rising quickly. You just got out of medical school or graduated with an engineering degree or a law degree, or you're in business now. And the next few years, your income is going to rise fairly well. Yeah, these things made sense for a very small percentage of the population. But there were entire companies that were selling these things exclusively. I will never forget this presentation given by this sleaze. This guy, just unbelievable. He was bragging about that he had a Porsche and what else? And a bummer, and he had just bought a Lamborghini. And his next purchase was going to be a jet. That's what he told us. And he said, well, I don't tell people I'll shop around for the best loan. I tell them this is the best loan. Yeah, for him. For him. Exactly. And what we're going to see is these things blew up in people's faces because housing prices stopped going up. And they started going down and down and down. And then these mortgages didn't go away. They started resetting, and people were looking at a house that was not $500,000 anymore, but $300 or $260 or less, $225. And they just started defaulting, walking away, stopped making their payments. There's a document on the website called Monthly Mortgage Resets. And we see how this train wreck was, the train fell off the tracks and just started destroying everything in its path, but just kept on going. Beware the option arm. Have I scared you enough? Good, I hope so. And we'll wait till you see the presentation about what happened to the housing prices. That's not up there yet, but it will be. If you are a veteran, the VA has some tremendous loan programs. So you want to definitely talk to the VA about your opportunities. And then FHA, for many years, was not very useful in San Diego because their maximums were just too low. Same thing is true for the VA. The maximums were just too low for many people in San Diego. But my understanding is they have made them higher so that more people can qualify. FHA is for first-time home purchasers who don't necessarily have the best income but want to get into a home, and it can be very helpful. Slide number 25. The graduated payment loans started with conventionals, but moved over to the option arm. It was a typical characteristic that just went crazy. It just became insane. But if you believe your income is expected to rise, you can talk to your loan broker, your mortgage company, your credit union about graduated payments. Interest-only loans were yet another symptom of the sickness that we all thought housing prices would never go down. I love the way they abbreviate these. IO loans. Yeah, right. IO, interest don't wait. If you pay interest, at least it's not as bad as the option arm, right? Where the negative amortization, the loan is going up, not down. Balloon payments. Balloon, what are these? Well, they're actually very useful for people who know that they're going to be leaving San Diego in 3 or 5 years or 7 years. Because what you can do is go to your loan broker and say, look, I'd like a 30 due in 7, 30 due in 5. And they'll know exactly what you're talking about. Sometimes you'll see 30/7, 30/5 in the advertisements. And what they're going to do is they're going to give you a 30-year loan, but at the end of 7 years or at the end of 5 years, you have to pay the whole loan off in one lump sum, the balloon payment. Well, people aren't going to do that. What are they going to do? Well, they're either going to refinance before then, or they're going to sell the house and move to another part of the country. And this is typical for people who say you're in the Navy and you know I'm going to be assigned here for 3 years, but then we're moving to Bremerton or back Norfolk in Virginia. So you can ask your broker for a 30 due in 7, 30 due in 5, and what happens is they will give you a better interest rate. What's your reward for taking this? Your interest rate will be lower because they know that they're getting their money a lot sooner. And it's a typical part of, as we'll see when we get to in a few more slides, the longer the money is out there, the higher the interest rate the lenders are going to require. Slide number 26. We discussed home equity lines of credit, a second mortgage, a second trust deed. And they can be very useful tools in case of emergencies and the like. The interest is normally tax deductible on Schedule A, but we saw that they can get us into trouble, especially if we deal with unscrupulous people. What is a reverse mortgage? You're going to see these advertised more and more as the baby boom generation ages. These are only available to you. I'm pretty sure that the age is still 62. They're probably going to raise it. But these are ways for people who've been in their house for a long time, the mortgage is paid off or pretty darn close, and they can have a reverse mortgage where money is being sent to them as opposed to them making the payments. And they can use their equity in their home as a source of income. Now, you better be careful. Get a lawyer, get somebody who's really knowledgeable about these things because there are sharks in the water. And there are horrible instances of companies because remember, they love to play on the elderly. They have a tendency to, especially the traditionals, the tendency to be very loyal. So you got to be careful. There are just numerous types of scams. And one of the biggest scams is the next bullet, shared appreciation. We discussed this shared appreciation in the previous presentation, where the grandparents or the parents share in the appreciation. But the lender can do it too. The lender could say to you, the borrower, and say, "Hey, we're going to make you this loan, but we want to if the price of the house goes up, the market value of the house goes up, we want to get paid for that. We want to be part of that." And you might go, "Oh, no, all right." But be careful, because there have been numerous instances where the lender has lowballed, it's called, has appreciated, I'm sorry, not appraised, not appreciated, appraised the value of the house much lower than it really is. And so they've instantly stole money from you. And these are rampant in the reverse mortgage industry. So just be very careful. Get a good lawyer to look over, or some other professional you trust. Look over the paperwork and make sure you're not getting screw-ed. Now, what's the cool part of a reverse mortgage? You can't get kicked out of your house. Or that's the way it's supposed to be. There's a link on the class website that discusses a situation where people have been kicked out of their house. But the idea is they're not allowed to foreclose on you until you go into the nursing home, or until you die, or maybe you sell the house and move someplace else. So that's the cool part of reverse mortgages. But I think I've impressed upon you the need, and most of you young folks are nowhere near this situation, but you might have parents or grandparents who are, so be careful. And then we'll discuss refinancing in a bit. You want to refinance to get a better interest rate. Interest rates have gone down. You'll want to get a better interest rate. You don't want to keep paying 6% now that interest rates are 4% and the like. Slide number 27. Financing and mortgage fees. It used to be almost impossible to compare apples to apples when shopping for a loan. A lower interest rate was usually a come-on in exchange for being soaked with garbage fees, and those were the names. Those are the names for the techniques that they used. It's a come-on. These are garbage fees. And the loan applicants often were not made aware of these extra fees until the day of closing. They're looking at this document, which is this HUD, Housing and Urban Development 1 settlement document with all these numbers on it, and they look at this. What's this $10,000 for loan distribution fee? What is that? You didn't tell me what the $10,000. Oh, that's the $10,000 loan distribution fee. Well, what is it? It's the $10,000 loan distribution fee. They won't tell you what it is. They're not telling you that they're going to charge you $10,000 to write a check. And you're ready to close on this house, and and you have to fight. And in some areas of the country, some states, it is just typical for you to bring a lawyer to the table when the day of closing or the day before closing. In California, no, but in some other states, that's because it's so rampant. But it is much easier and safer now because new rules forbid bait and switch maneuvers that used to be commonplace. You can see their best guess, and remember, things change every day, so and of course the most important thing is when does the house actually close, and that changes the numbers, so they'll show you what our best guess is, and then they'll actually compare it to what the actual price is. So this is interesting how this came about, because in 2003 there was an effort to create a standardized method, and the industry shut it down. But after the 2007, 2008, and then subsequent crash, debacle in the home loan industry, the home loan reform advocates finally got their way. It takes a disaster before the industry will actually fess up to the problems that they've created, and they'll say, "Ooh, but we want to be flexible. We want to be able to flexibly charge our clients." So, yeah. Slide number 28. Should I have a large down payment? Should I pay off my mortgage early? Well, the truth is the two are the same question. And what you're asking yourself is, how much equity should I have in my house? How much of my house should I own? And how much should the bank own? Isn't that nice? The bank owns they're the ones who own the house. They just let you live there. But the real estate agent will say, no, don't make a large down payment. Don't pay off your mortgage early. You're going to buy a new house every 4 or 5 years, right? So that she can make another commission. The financial representative says, oh, no, you should invest the extra in a mutual fund so he can make another commission. I says, if you intend on staying in your house for more than a few years, if it's a long-term proposition for you, yes, pay down the mortgage, have a large down payment, make love, not loans. It used to be a virtue when people would pay off their mortgage. They'd have mortgage burning parties. It used to be something that we celebrated. And then it became something that was just You stupid. What is the matter with you? And you're going to hear different points of view, folks. I will never forget. This was in 2007, right? That was right before. People were still clinging to the idea that it was just a pause in the housing, the run-up of housing, and it was about ready to charge ahead. And I was at this party, and some of these people were very well off, and they were just scathing in their pronouncements about my recommendation to pay off the mortgage. And I forget how we got on the topic, because they knew I teach this stuff. And you teach people to pay down their mortgage? What's the matter with you? That's ridiculous. You want to die with the biggest mortgage you can have. And I thought, are you serious? I mean, first of all, you don't know when you're going to die. That's the problem. If you did know when you're going to die, you could write that last check to Vaughn's and have it bounce after you pass on. But you don't know that. And the one gentleman was saying how they had just put an offer on a house that was on the market for $1.6 million, and they put a $1.2 million offer, and they were sure that in a couple of years this house was going to be $2 million. And I'm thinking, okay, good luck. And then, you know what? Every time I see them now, I just smile. We never talked about it again. Never talked about it again, because 6 months later, it was evident that the housing market had fallen into a funk. And then a year later, the financial system crumbled because of all these mortgages that were packaged together and sold as bonds around the world, and all these people were defaulting and just stopping to pay their mortgages and not even leaving. Some of them were leaving. They were given the keys to the bank. Others were just saying, we're going to stay here until you get me out of here. And every time I see them now, because I ride bikes with them, I just smile, and we never talked about it again. Slide number 29. Should I refinance? Well, when interest rates trend lower, many homeowners consider refinancing their mortgage and getting a lower interest rate. Payments usually go down as a result, but you can incur points and closing costs all over again as when you purchased the house. Because what you're doing is you're essentially selling your house back to yourself, if that makes any sense. I'm not a lawyer, folks. I don't know, but that's what I'm told. The rule of thumb is if you can get your rate down by 2%, go ahead and refinance. But the problem is you have all these closing costs. And you're going to take a look at the points versus interest rates document on the website. So what if you could go out and get a no-cost or a low-cost refinance? Some of these, you have to pay $300 for the appraisal and $50 for the credit check. And that's it. Now you're going to pay a higher interest rate, but what do you care? It's lower than the interest rate you're paying now. So even if you can get it down by 0.5% or a percent, go ahead and do it. It makes sense to refinance, in my humble opinion, instead of paying $4,000, $5,000, $7,000 to get a better interest rate. Now, this is your decision, but do look at that rates versus points, and you'll see what we're discussing. What the two opposing ideas we have. Paying a higher points, higher closing costs, getting a lower interest rate, or paying very little costs, no points, getting a higher interest rate, but still bringing down the interest rate from your previous loan. Slide number 30. The closing costs. And why do we call them closing costs? Because you close your eyes and snow. I know. That's the way you feel. You just want to go, oh my. Wait till you see how many documents. There's 120 sheets, and now you have to sign or initial every one, and there's a notary there, and there's people stamping it, and you just, what is all this stuff? Well, blame the lawyers, folks. Blame the lawyers. But remember, before there were lawyers, it was pistols at dawn. Title insurance. What's that? We got a separate slide for that. Very important you understand what title insurance is. Escrow fee. These are the bean counters. These are the people who do all the paperwork and get everything, make sure that everybody gets paid correctly and the money goes in the right place. The attorney's fees, as we said, in some states, you bring an attorney to the table. In California, it's not customary, but don't think you can't do it. You can do it. You just got to pay the attorney. The appraisers, some of these people are real little Hitlers, little dictators, and they just they I think it goes to their heads. And others are trying to be responsible. Some of them were complaining that in the run up 2006 and 7, they were saying, but these houses aren't worth this much, and they were getting yelled at and screamed at by their supervisors. So they said, all right, what do we do? Well, if this is what people are paying. And then when housing prices were going down, they were being yelled at and screamed at when they would appraise them really lowly because market prices were going down. They said, but this is what people are paying. And then they were getting yelled at and screamed at again. So some of the appraisers, the honest ones, they can't win for losing. The property survey, the recording fees, the transfer taxes, the credit report, the termite inspection, the lender's origination fee, that's the fancy term for the points, the taxes and insurance reserve. They're going to create a what's called an escrow account, and an account at the lender where you pay not only the mortgage, the principal and interest, but you're also paying every month the taxes and the insurance, and they start with a certain amount. They call it the reserve. And then any prepaid interest you have to pay, and of course the real estate commission, which is normally paid by the seller, but you can negotiate that. Now, what's a walkthrough? If you've made any kind of deal with the seller, oh yeah, we want you to, will you throw in the washer and dryer? Will you throw in that chandelier? And the seller says, sure, I'll throw it in there. Yeah, we'll make it part of the deal. Well, if you don't check the day before or the day of closing that they kept that washer and dryer in there and it's gone, what are you going to do? Oh, we're sorry, the movers. The movers, by mistake, they took the washer and dryer. It's on its way to Bremerton, Washington. So you make sure that they don't stiff you the things that they said they were going to stiff. I could tell you a little. Anyway, slide number 31, title insurance. Very important. Very important. Of course, the lender isn't going to even sell the place, isn't going to let you, buy the place and create the mortgage without title insurance. What does title insurance do? It guarantees that the seller owns the property. Wouldn't you like to sell something for $500,000 that you don't own? If you had no scruples. That the seller and the buyer are who they say they are. That there are no liens or other encumbrances on the property. You get the property and all of a sudden you find that, hey, this property has a $50,000 lien, which means somebody is owed $50,000, and the house is what is securing that debt. The title insurance company makes sure that doesn't happen. If it does, it's their problem, not yours. If your home was purchased or refinanced within the past few years, you can ask for and should get a substantial discount on the title insurance policy. It definitely pays to shop around for title insurance, folks, because the prices are all over the map. It's unbelievable what some companies do. They throw a number up in the air and see who'll pay it. In some states, they require a transparency, and prices, I think Iowa is one of them, prices fell. I forget the actual number. I got to go back and research that. But they fell an outrageous percentage. So don't assume that the company your real estate agent suggests will give you the best price. Yeah, you can. Yeah, you can shop around it, and you should shop around, and you should be able to get a discount, especially if you refinanced or the home was purchased within the past few years. Slide number 32. We've been discussing how to buy a home. Now let's take a look at selling our home. There's a wonderful book that we'll take a look at later on when we get to investments called Investing in Fixer-Uppers. And he says, you're going to sell your house? Put up a white picket fence. You know, it'll cost you $2,000-$3,000, maybe more, $5,000, but it'll be worth $25,000. People love a white picket fence. I don't know. I couldn't care less. Where are you going to determine the selling price? Well, the appraiser will charge you upwards of $350 now. It's going to happen anyway. The realtor will say, "Oh, we'll do it for free," because they want you to sign up with them, so they'll do an appraisal. But again, check Trulia, check Zillow, ride around on your bicycle for the neighborhood and see what others are paying. You can sell your house by owner, but folks, it's gotten really difficult. It used to be a whole lot easier. But I would get my real estate agent's license if I have to save $30,000 or $40,000. But I also have sales experience as a stockbroker, as an insurance agent, so it's tough. You know, all the documents you have to put together. Listing with a real estate agent is normally 6%, but they'll tell you it's negotiable. For you, we'll charge you 6%. Maybe today's special 6%. Yeah, they claim that they're not really a monopoly, but they do their best to hang on to that MLS and not let anybody else look at it. They hate Zillow. They hate Trulia. Keep your back to the wall when you deal with real estate agents. You ever see their pictures? That's the thing they click. That's the tick off. That's the thing that really shows who they really are, because they have these smiles. You can't smile like that. It hurts your face. But they Photoshop it, or maybe they just, they freeze their face to make it look. Anyways, continue at slide 33. What are some of the tax consequences of selling your home? Well, folks, the current laws are very favorable to home sellers. If you purchase your home and sell it for $250,000 more than you paid for it, that's a capital gain of $250,000. That's tax-free. Anything up to $250,000 if you're single, $500,000 if you're married. So you could buy a house for $100,000, sell it for $350,000 if you're single, and not pay a dime in capital gains. Sell it for $600,000 if you're married, and not pay any capital gains. And you can do this once every 2 years. There's some people who are still confused about the old rules back in the 1990s, but no, you could do this every 2 years. Some people think you can only do it once. No, some people are doing this. They're buying fixer-uppers. Now it's hard in San Diego because the competition is so fierce. But you buy a fixer-upper, you live in it for 2 years, fix it up. Normally you have a day job too, and you're good with hanging drywall, fixing plumbing, and the like. And then you sell it, no capital gains, taxes. Pretty darn amazing. If you lose money on your home, you cannot use that as a capital loss. You can't write it off. Why? Because it's a home first and investment second, in my humble opinion. Depends on who you talk to. Now, now it's time to take a look at how to calculate mortgage payments. This is somewhat similar to the future value tables that we did in Chapter 1. And 30 years ago, 40 years ago, when you would walk into a real estate office, a mortgage broker's office, there would be these tables lying about the people's desks, huge tables. Well, ours is going to be very small. But they're all gone because everybody's got a handheld device that does it in a few seconds. These tables were used to calculate the principal and interest on a mortgage. And that's what we're going to learn how to do. Using the manual tables, of course, you can get an app for that, or just go on a website of one of the mortgage brokers or mortgage companies and find out what your payments are going to be. And the news is actually pretty good for people at the lower end of the housing market in San Diego, because the payments are actually pretty comparable to what you're paying in terms of rent. There's a little bit more, as we said, but still, you own the place sort of, kind of, in 30 years. All right, so let's take a look at the current rates. We're about 3.5. Some people are less, for a 30-year loan, which is something I never thought I'd see in my lifetime, certainly. But now, my goodness. And so that makes the housing more affordable. The problem is, can you qualify? Do you have the down payment? So on a 3.5% loan at 30 years, what's this payment per $1,000? Well, what we're going to do is we're going to run over to the mortgage amortization table. Here it is. Look familiar? Years, percentages. Yeah, kind of like the future value tables. And so what we're going to do is we're going to go down to 30 years, across to 3.5%, or you could go across to 3.5%, down 30 years. You decide. And we have 4.490. Now, what is that? That's the payment per every $1,000 that you borrow. So what we have to do is we come over here and we put 4.490 right here. But then on a $300,000 loan, we multiply that 4.490 times the 300,000, but you have to divide by 1,000, okay? Because it's on a payment per 1,000. So what I instruct you to do is just cross off the last 3 zeros. If you divide by 1,000 on your calculator, that'll give you the same exact answer. Just remember that the payment is not 13 million, or no, $1,345,000 a year. It's nothing, you have to divide by 1,000. So multiply the 300,000 times the 4.490, crossing off the last 3 zeros or dividing by 1,000, and you get a payment of $1,347. Folks, that's not that bad, is it? A 2-bedroom condo, maybe a 3-bedroom condo for $340,000, $330,000. You put down $30,000. Considering what rents are like now. But you got to also come up with the taxes, which are going to be another $1,000 a month or more, $1,200, $1,300 a month. No. What am I talking about? They're going to be about $1,800 a month or $1,900 a month. No, I'm not saying that. No, I am so sorry. I'm getting all confused. The property taxes on about a $340,000 house would be about $3,000 a year. So there'll be about $300 a month. What was I thinking? I don't know. I'm so sorry. Yeah, about $300 a month. And then the insurance is going to be about $80 a month, depending, if you shop around. And then utilities. So you're looking at, close to $2,000, but still, for a 2-bedroom apartment these days, yeah. So how long are we going to do that? My apologies. Where was my mind thinking? We're going to do that for 360 months. Huh? Yeah, well, 12 months in a year, 30 years, 12 times 30 is 360. After you make the first payment, you can turn to your spouse and say, just think, dear, in only 359 more payments, it'll be all ours. Anyway, what's the total cost of the loan? So you multiply that monthly payment of $1,347 times the 360 months, and you wind up with a very large number, $484,920. And when people see this, they just can't believe it. Well, now remember, 300,000 of it was the bank's money, so relax. Yeah, you're paying $185,000 in interest. Remember back in chapter 4 when I said when you grow up you want to be a bank? And at 3.5%, folks, this number is very small. Try it for 6 or 7%, which is the 100-year average for interest rates, and see what kind of mess you'd be in. Yeah, right. Interest rates are not going to stay this low forever, folks. Are you with me? Understand? Yes. That's why you want to be a bank when you grow up, because it's a license to make money. So not because they're getting the money for nothing, right? They're not paying hardly anything on it. If you go to your mortgage broker and say, well, you know what? We think we can afford a bigger payment. We think we can swing, $2,500 a month. Will you give us a 15-year loan? And they'll say, oh, yeah, sure we will. Sure. They don't normally sell too many of these, but they're becoming more and more popular, especially with people who have two incomes. And the first thing they'll do right off the bat is drop the interest rate by 0.5% or more. It depends, market conditions. Why? Well, that makes sense, folks. The longer the money is out there, the longer you lend the money for, the more opportunities for things to go wrong. So, with a shorter time frame, the lenders are willing to give you a better interest rate. So they're going to give us 3%. Cool. And we'll take that. We go to our mortgage amortization table, and we see that for 3%, coming across the 3% down to 15 years, the payment per 1,000 is 6.906. $6.906, right, cents. And so we come back to so make sure you understand that. So let's like the future value tables. We come back to the presentation here, and we see that we take that 6.906 and we multiply it times 300,000. Yes, right, 300,000 divided by 100, so cross off the last three zeros, and you get 2,071.80. Make sure, not 2 million, okay, right? Divide by 1,000, cross off the last three zeros. So you might have thought, or many people think, that a 15-year loan, the payments are going to be double. No, that's not how it works. No, you see, in the first several years of your mortgage, most of what you're paying is interest. You're paying interest payments. So what happens is the principal payments are smaller. So the principal starts going down slowly. And then later on, at the end, most of what you're paying is principal and you're paying very little interest. So if you can front load that, if you can make higher payments at the beginning, you can drop the number of years of the loan quickly. And so if we want to go to 15-year loan, 15 years, we only have to come up with $2,071.80. That's $724, right? Not twice, but about 50% more. Okay. And here's the money pitch. How long are we doing that for? We're only doing that for 180 months. 12 years. 12 months. 12 months 12 months per year times 15 years or 180 payments. You see, this is the cool part. If we multiply the $2,071.80, the monthly payment, times the number of payments, that's only $373,000, a little less than $373,000. Almost $112,000 less than the 30-year loan. Pretty cool, right? Pretty cool. Remember, $300,000 of that was borrowed, so we're winding up spending, instead of $185,000 in interest, we're winding up spending about $73,000 of interest. But that means we got to come up with that $724.80 every single month. You don't make your mortgage payments and the bank gets very, very testy, very upset with you. And if you don't make your mortgage payments for several months, they come and take your house away. For that reason, many people will say, okay, let's stick with the 30-year loan, the lower payment, but every month, let's put a couple $100, or maybe once a year, make a 13th payment. Make we get a bonus or our tax refund. We put that against the loan, and you will drop the number of years by many, many years. Now, if you have no intentions of staying in this house more than 4 or 5, 6 years, don't bother. You're going to be moving anyway. But if this is your home and you plan on staying there, sure, paying it off is great. There are some companies that will advertise, we'll make 2 payments a month. You pay us every month, and we'll make 2 payments for you. They're going to pay the mortgage company every 2 weeks, which will drop the loan faster. But folks, it's something you can do on your own, and they're going to charge you for this. So I think you should do it yourself. It's a lot easier. Plus, what happens if they go out of business and disappear with your money? So think about it, folks. Do you want to pay down your mortgage quicker? Can you afford the extra payments? remembering this doesn't include the insurance and the taxes, and I'm sorry, and the taxes, insurance, and the utilities. Yeah, exactly. So at about $400 or $500 a month. It's a great time to buy, really, folks. It is. With interest rates so low, you can get get payments that are very similar to what it costs to rent in San Diego. And the cool thing is, if you get a fixed rate mortgage, okay, I'm enough lecturing. So you now know how to do the calculations, right? It's time. Yes, it's time to do some more exercises. And in the face-to-face class now, we would pull out the mortgage amortization worksheet, which is on Chapter 7. So I want you to do that also, okay? Make sure, do it a few times. So do it for different interest rates. You're going to see the rates versus points. You're going to see some examples of rates that are out there. I'm going to ask you to go out there and find some rates, and then calculate do the calculations, because they're on the assignment sheet and they're going to be on the exam, but they're really not that hard. So, dear students, what do you think of our discussion of housing, the largest expense on our cash flow statements? Yeah, it's well, you could live in Youngstown, Ohio, folks. It's a lot cheaper to live there, but you'll be in Ohio, which is not a bad place, folks. I've been there, but it ain't San Diego. In our next chapter, we begin the important discussion of insurance, the necessary evil. See ya!